What kind of options do we have in our pocket if we want to save money on taxes?
I'm not a big advocate for down payments. I can make more money than the interest rate provides with my liquidity.
Yeah. So you can write off your dog. You just need to make your dog a security animal for the business. If you're renting your residence, can you rent out that rented residence? Yep. Welcome to Mentors Collective. Today we're attacking a subject that everybody loves. And I'm joined by my friend Antonio, who I met on our 2024 Entree ski trip.
Yes, sir.
In Banff, Canada. And he gave me some unbelievable tax saving advice for our business. So I thought it would be prudent to have you on the show to share with some of the other entrepreneurs, or maybe not even entrepreneurs, maybe even W-2 employees who can save on taxes that aren't utilizing the current code. So Antonio, thank you for joining me.
Thank you for having me, man. I'm very excited. What you guys got going on here is incredible. Love the business model, love the building, and a cool little case study for actual tax savings on how you guys went about executing this as well.
It's true. We can start with that if you want. I'm sure you kind of understand what we did with this building, but
yeah,
we essentially got a free building other than our monthly payments. But
so with that, it's funny because we met in the like a sauna steam room hybrid in Canada.
We were sweating together.
So out of nowhere, we were. I saw you guys in a robe walking through the middle of the hotel lobby. I'm like, what are you guys doing?
You're like, cute. I'm going.
Yeah. And so with that, we had chatted. You're like, oh, I'm from St. Pete. I'm like, oh, cool. I'm in Tampa, etc. And you're like, oh yeah, we just bought this commercial building. Immediately I was like, did you cost seg it? And you're like, yeah, we bought it, we self-rented it, we used the cost segregation study, et cetera. So it's cool that we're sitting in a live case study of how you guys went about executing it. And I'm happy to kind of like peel back the layers on how you did it, but we'd love to hear a little bit more about what the process was for you guys, and then I could kind of fill in the gaps if you want.
Yeah, it's funny. Every year we try and look for something different to save on taxes. It can be really tough, especially playing with the rules. Our CPA versus our tax strategist are always button heads.
Yep.
So one of the things we came up, because we were paying like 10, 20 grand every month in rent for our team at a co-working space. So I actually discovered the cost seg thing, scouring YouTube for like tax saving tips. And he's like, you know what? That'll work. You guys can do that as long as you like occupy the building. So what we did is found a building to buy. This was a $3 million building. We got it funded with the SBA, so they gave us a loan. We got a bank to sign off on it, and had to put 20% down, so that's like $600,000. Now, a cost seg, which I'm sure you'll be able to explain in much better detail than I will, a company comes in, a company essentially designed to help you save taxes. That company comes in, and they value everything in and around the building and say, okay, this stuff is going to depreciate faster than that stuff. And then the stuff that's going to depreciate in the first 5 years, based on their report, you're able to write off 100% of it in that first year. So that saved us like several $100,000 worth of taxes
net
first year.
Like net that you don't owe the government. Yeah,
unbelievable.
So that's the cool part, especially with commercial, because commercial is so much larger typically than residential properties. Yeah. So a commercial property typically goes on a 39-year depreciation schedule. So obviously you're buying this property with the intent of the value of the property going up.
Yeah.
You're kind of breaking even on the mortgage, hopefully, to make sure that you're occupying the space. It's just a more advantageous play if you have the liquidity like you did at the time.
Yeah.
So with that goes on a 39-year schedule. You could take the value of the property minus the value of the land and take that over 39 years. Cool. It's a decent tax write-off. But if you do something like a cost segregation study, we can go inside of the property and identify parts of this property that go on 5 and 15-year schedules as well. Right. Some parts of the electric, the parking spots, all these different things that go on, the windows, the HVAC, electrical, etc. Everything gets classified in its own 5 and 15 and 39-year property. And when Trump did the tax jobs and that act, he basically put into effect this bonus depreciation schedule. And if you did it in 2022, it was still at 100%. And with that, anything that's under a 20-year depreciation schedule, you actually take in year one. So you're still realizing the same benefit over a 39-year period. But when you factor in like the value of your money and time value of money, having more liquidity now is significantly more valuable than stretching it out over 39 years. So the less I can legally pay the government today, the more liquidity I have to grow my business, hire faster, market more, buy more real estate, et cetera. So that's kind of my philosophy around it. And to your point about the CPA, strategist, et cetera, I'm a big believer as you're growing in a threefold approach. Yeah. You have your CPA here, who isn't really providing you much strategy, but you're confident that they're going to get the job done from a filing standpoint, that you're not going to get audited and everything's going to be good and up to par there.
Their job is to keep you safe.
Exactly. And safe and entrepreneurship are kind of like oil and water. Like I want to be aggressive. I like risk, etc. I'm a big believer in being aggressive inside of the scope of the black and white.
Yeah.
What the IRS tells me I can do, perfect. Let me go substantiate it and be as aggressive as possible. Because the less money I pay them, the more money I have in my pocket. And so with that, I'm a big believer in the CPA here, the bookkeeping team who's just translating the data and doing like the day-to-day work that, it's monotonous that needs to get done so I understand my data. And then you have your strategist who's that centralized hub who controls what goes where and the strategies, who's going to the CPA to say, hey, this is what we should do and here's how we should execute it. Then the CPA signs off on it, et cetera. So we have all these decentralized, silos here and one centralized hub that's making sure everyone's running the place properly.
Yeah, that makes a lot of sense. And the CPA, mine tends to have a very low risk profile. I assume most of them are like this. Recently, he's been trying to get me to do things that I consider to be insane. Like nobody must do these things.
Sure.
He's like, oh, you want to write off 90% of your car as a business expense? You need to track every trip and the miles spent on that trip and like calculate the percentages. I'm like, who the hell does that
Yep.
in their day-to-day life for every dinner that you write off? He's like, yeah, you need to note who was at the dinner and what you talked about. Mm-hmm. How much of that do you think entrepreneurs need to keep in mind? Like, do people do that? Is that something, if you were to be audited, that they would even check or expect you to have?
They will. It depends on what you get audited for, right? So there's specific times where you get audited for just a piece of information that they're looking for, and you give them that substantiation. Great. If you're filing on Schedule C, so let's say, for example, you're a 1099 salesperson as opposed to a business owner that's maybe files as an S corp.
Right.
You are over 10 times more likely to get audited by writing off a lot through Schedule C, because let's say I'm making 30 grand a month in high commission sales or high ticket sales. I'm going to try and find out how like all my dinners can be write-offs, my mileage, et cetera. If you're just zeroing out every year, that's going to go on the IRS's red flag, because everything goes into an algorithm. And once it hits that a point of like extra risk, then it goes to a human who starts to look at it under a microscope. So I'm a believer in any bit of documentation you can get over documented, especially for someone like you that you have a lot of going on social media as well. Yeah. So they're going to look to that as substantiation or something against you as well. So just be cognizant of that. The meals you should be fine with. The mileage you can use like QuickBooks to track it, et cetera. 70% is usually a pretty, like 70% business use is a pretty like moderate aggressive approach. And then over documenting everything that when it comes to any higher risk plays, I'm a huge believer in taking the dollars we're already spending and finding ways, getting creative around how can we use this as a business deduction, but we have to create the proper substantiation around it, if that makes sense.
Do you have any like examples for that?
Perfect example. So a client owns a law firm. Law firm's probably doing about 10 million of top line revenue, about $3 million in EBITDA. And this dude loves fishing, like obsessed with fishing. Bought a $3 million fishing boat. It was like a couple $1 million and then put in a ton of money into the boat.
Dude wrote off his fishing boat? I'd love to hear this.
Yes, he wanted to write off the fishing boat. Comes to me, is like, hey, how do I write off the fishing boat? I was like, you don't. Inside of a law firm, it's very tough to attach that. You can technically write off anything, but if they audit, you're probably, it's probably going to get kicked back. But it was a large enough expense to where we recommended that he create an entire new business around that boat and using that boat as marketing collateral. The reason why that the boat is there is for the business. And so with that business is a lifestyle brand that sells apparel. It has its own insurance. It has its own P&L. It's truly attempting to make money. And the boat is attached to the business use there. We took depreciation all on that boat. That flew up a massive negative K1 up to the tax return, and it offset, his entire law firm income there. Yeah. So we took what was a hobby and a personal expense, translated to a business, truly trying to make money. It's a real business. It has real insurances. Right. It's got, everything online presence, et cetera. And it's trying to make money, but it takes, a massive loss at the end of the year. And that's how we kind of went about that strategy.
Interesting. And this goes back to what my accountant always tells me. It's like, what are you willing to fight in the case that you get audited?
Yep.
So that's a perfect example. I mentioned to my accountant, because I watch YouTube, I'm trying to save money. I saw some YouTuber, he's like, you can write off your dog. You just need to make your dog a security animal for the business. And then all of the food, all of the vet bills now becomes a tax write-off. I called my accountant, he's like, bro, I know how to write off my dog. We got to implement this ASAP. He's like, you got to get off YouTube and stop listening to these motherfuckers because there's no way that I'm going to sign off on that. Like, if you get audited, you're screwed.
I write off my dog, actually.
Do you?
Well, she is a German Shepherd, so much easier to substantiate her being a guard dog.
My golden doodle's not defending shit.
Yeah, so I mean, I have an extensive list of pictures of her, at the office overnight, etc. We're attaching like any specific payments sometimes get sent to, for the specific guard dog services, etc. So I'm creating substantiation around it. And like, I'm going to continue to feed my dog and continue to bring her to the vet, etc. So now those get attached to income generating activities that then could be write-offs.
So this is actually really good stuff. The boat, the dog, it's not so much this is sketchy, this isn't. It's what kind of paper trail and story can I build around that tax write-off, where if I were to be audited, then I can show them the paper trail, I can show them the pictures and all of the substantiation, and then what do they have left to say?
Exactly. So there's a really good book called Tax-Free Wealth by Tom Wheelwright, and it pretty much talks about everything under the sun and how you can substantiate it being a tax write-off. So literally anything could be a tax write-off if we can find a way to attach it to business use.
Right.
So Section 162A basically allows you to identify what classifies as an ordinary and necessary business expense. That's an arbitrary thing where it's like a subjective thing. What category? What do I need to actually create business? Some people just get a little bit too aggressive and ultimately just try and write off everything. I'm a big believer in getting aggressive where we can have the proper documentation.
Yeah.
Getting aggressive inside of the scope of the black and white. The gray areas, like saving money on taxes, I love. Getting audited, I don't love. So being in deep shit with the IRS is much worse than the temporary happiness of not paying taxes does. So with that, I'm a huge believer in paying the least amount we can while still being attractive to banks, if we can do that. So, for example, let's say your business makes X amount of dollars. Let's say that number net income wise is $1 million. Now that's going to flow down to you from your S corp to your personal tax return as ordinary income.
Yes.
How can I continue to keep my profit and loss statement clean? Because maybe I want to sell my business or attract investors, et cetera. I want my P&L to be super clean and that data to be really good. I want my business to be profitable. But then everything flows through to my 1040, which is my personal individual tax return. How can I create mechanisms around using leverage to then wipe out that tax bill? Because you're subject to higher than 30% tax bracket inside of that $1 million of an income. And so with that, how can I take that $400,000 to $500,000 tax bill that I might owe and maybe only make it 10 to 12% effective taxes? That delta, if I'm paying $100,000 in taxes versus if I'm paying $500,000, that's $400,000 tax free that I have to continue to grow my business.
Right.
And so I do that through creating, strategies around real estate cost segregation, potential plays around oil and gas exploration, et cetera. Like, I'm not a huge believer in spending money to save money on taxes. But if I'm already spending the money or if I'm investing money, specifically if I can do it via leverage and use the bank's money for most of it, now I'm creating a lot of tax value behind it and getting, significantly more dollars back to my bottom line. So
yeah, I'm excited to hear about like the game plan that businesses can follow to save the most money. Let's talk for a second about getting audited and things businesses can do not to get audited. Do you have like a set number of rules or suggestions that businesses can follow not to raise any red flags with the IRS?
I think a lot of it also has to do with making sure you're aligned with the right tax professional as well.
Yeah.
So your CPA, a lot of the times, if the CPA is ultimately too aggressive or is doing things out of the scope of integrity, they get like a return gets audited and then they start to audit the entire CPA's book of business. So now you're guilty by affiliation.
Right.
So those types of things, making sure if you're going to make aggressive plays that they have substantiation. So for example, there's a strategy called like conservation easements or charitable land grants that somebody might have talked to you about.
No, never heard of it.
It's a really cool strategy and you can get it done properly. I've interviewed about 100 firms that do this. I've only selected 2 that I'll work with inside of that scope because not everyone does it right. And these 2 build in audit defense in their pricing model so that there's a sinking fund available to pay the auditors because an audit's coming.
Right.
But it'll fly by an audit. So it's not about getting audited because you can't really control that. But then can I substantiate an audit? That's significantly the next level.
Right.
So the conservation
but
easements.
also being ready for it. So if you do get an audit, because eventually I feel like you will.
Yep.
The more money that you make, I mean, what percentage? Are they likely to audit every business that's making over $10 million?
About 4% of about 4% of Schedule C's get audited a
These are
year.
the freelancers, the 1099s.
Yep. And then about 0.4% of S corps and partnerships.
Okay, great.
That's the data. So it's not,
low.
it's less about the money you're making and just more about, kind of what you're actually filing on your, as your expenses,
Yeah.
et cetera.
Tell me about this strategy.
So charitable land grants, it used to be called conservation easements. This is I would classify this as a higher risk play. You can basically buy a piece of undeveloped land, raw land, and you can do this with a fund now, which I would recommend using a fund to do this. And let's say that land, just to be conceptual, that land's worth $100,000.
Sure.
I'm going to go get someone who can professionally appraise this at what it would be for the best business use value of this land. Developing on it, solar farms, oil well, drilling for oil, all those types of things. Those are all scenarios that I've seen. I'm going to now take that property, that $100,000 that I spent on that property, and donate it all to the government. So I'm out $100,000, but I'm actually able to get a tax write-off based on the reappraisal value of that property. So let's say if it reappraised at $500,000, if I did develop on it, I get a $500,000 write-off for my $100,000 investment. So now I'm using leverage and creating multiplication.
Wow.
Where people got crazy with it is they were saying that it was worth 50x, 20x,
Right.
100x. Like people were just getting way aggressive. Right now, 5x is about like where we're seeing it be stable. What's in that strategy? So now it's like if I spend 100 to save 500 or net maybe 30% of 500, whatever that number is. Now that math starts to work out if I have no other plays available towards the end of the year.
That sounds like a very high effort play, like spending money to save money, but also spending a lot of time. You got to find the land. I assume you have a company that comes in and does the appraisal.
That's why we use a fund.
What do you mean by a fund?
So there's pools of investors that do this with someone who will just manage all of this. And the way that they do it to make sure that it flies by is that you have voting rights inside of this fund to say, hey, yes, we want to donate it. No, we want to keep it. Or 3, we want to actually develop on the land. 99.99% of the time, everyone chooses to donate, but everyone at least has that option of a vote. And so it passes through to all you, and the manager takes a management fee for doing all this stuff. And for me to pay 1% on this or whatever the percentage is from the manager,
Right.
significantly more passive for me, and I still get the write-off for it.
Okay, very interesting.
Yep.
All right, talk to me from a business perspective. What kind of options do we have in our pocket if we want to save money on taxes? We already talked about one, which is bonus depreciation, buying a building. But I spoke to our strategist, I spoke to our CPA. That's not something that we can get away with every year.
Sure.
And neither me or my co-founder Scott can technically be tax professionals since we're both obviously full-time in the business.
Yep.
Other than that, kind of what tools do we have in our pocket, in our tool belt?
Are you guys married?
Me and Scott
Yep.
to each other?
No. Do you guys?
No, neither of us are married yet, and our CPA keeps telling us to get married so that we can make one of them the tax professional.
That is
I don't know
a
if
way
that's
around
reason
it.
To
Don't rush it just yet, just to get the real estate professional.
tax savings.
So with that, I mean, it all depends on what level of business are you at, right? So if you're, below $1 million of revenue, starting to scale your business, I think the focus should just be on making more money. You should not be like scared to make plays just because taxes come along with it. Like it's a great problem to have if you have a, more tax liability, because that means you made significantly more money. So let's go figure out that solution after you've made a bunch of money. Because the alternative is being broke, which is like, yeah, if you don't want to owe taxes, you could always be broke.
Step one, don't be broke.
Not an advocate, yeah.
Figure out how to make money and get your business to that point.
As we're starting to scale, and everyone has different arbitrary numbers on when this makes sense. Let's say 50 to 100,000 plus of net income. That's when we probably want to explore filing as an S corp. Putting yourself on a small W-2 salary that's reasonable within the IRS's eyes. Everything else above that in the form of distributions you take are no longer subject to the self-employment tax that you typically pay on Schedule C. So that's another play. The S corp then opens you up to a ton more opportunities. Opportunity like the Augusta strategy. The Augusta rule. Are you familiar with that? Do you guys use that?
Vaguely, we don't use it, and I didn't know you can use it for like a business like this, like our marketing agency. But walk me through the Augusta rule. What is the Augusta rule?
The Augusta rule actually allows you to rent your primary residence where you live to your business for up to 14 days out of the year for a normal use. Or you can just rent out your home. So let's say for like Airbnb or something like that, you can rent it for up to 14 days, short-term rental, tax-free. So the money is completely tax exempt. I don't have to file it on Schedule E on my tax return.
Right.
Now, where it comes applicable to the business, I can rent it to my S corp or my partnership for a specific use. So corporate retreat, if you're hosting clients, for example, if we were to have this podcast at your primary residence, you're leasing this podcast to your business, you might as well lease it, do it at your house. And now we have a venue. And we could figure out the data on what it would cost to run this podcast at in this business for at your house. And so we're going to help you create all of the meeting minutes and supporting documentation around it. You would then send an invoice from the business, from yourself to the business. The business takes a tax deduction at the S corp level. The money flows to you tax exempt. So for example, if you and Scott were to do that each, let's say we did that $1,000 a day each with legit substantiation, you get a $14,000 write-off at the business level times 2, which is $28,000. The money that you were probably going to take in a distribution anyway, that then flows to you separate. So now you're just taking money from your right pocket, putting it into your left. I say it all the time for reasonable use. I don't want to say it for clickbait. Like, you need to have a legit reason as to why you
need the story, you need the documentation to make it make sense.
Everything that we're going to talk about, sorry to cut you off, is always subject to, like, disclaimer, have documentation and supporting documents around it. But outside of then that money flows to you tax free, and it's just a way to double dip the tax code.
Cool. 2 questions about the Augusta rule. The first, if you're renting your residence, can you rent out that rented residence?
Yes.
And still make that yes.
Okay. A large percentage of the time, as long as your lease agreement allows for it. Yeah.
Got it. What about this building, which is owned by our partnership? And then me and my co-founder, like you mentioned, both have S corps, so avoiding the payroll tax.
Sure.
Can we rent this out to our S corps and then have it kind of do it in reverse?
It has to be a primary residence or a vacation home.
Got it.
For it to qualify for the Augusta strategy specifically, which is Section 280A for anyone doing the research.
Okay, beautiful.
So now that you brought up a great point, another layer, partnerships. You guys have your own individual companies that then get paid out.
Yes.
So this business files as a partnership. The other businesses file as S corps.
Yes.
Cool. So this is not an S corp.
Correct. This is a partnership LLC.
Okay, great. I sometimes I recommend that, because now you have your management companies that then flow through to 100% to you.
Yep.
You can do your own individual tax planning at the management level that you own 100% of, instead of splitting everything 50-50.
Yep.
Because there's a lot of deductions that you guys might want to split 50-50. But let's say, for example, you and I went out for a meal and you were taking me out to dinner or something like that. You paid for it. And there's a way for us to justify it as a business meal. But maybe Scott doesn't want to pay for 50, knowing me and you, we're spending $2,000 at dinner as well.
All the time.
And so with that, this allows you to still get the write-off and qualify and keep it clean under your P&L, but not have to split it 50-50, et cetera.
Yeah, if you have a partnership, I feel like you almost need that. Like the partnership on top, and then you need to pay yourselves into an S corp.
And I'm a huge believer in doing that if you want to create max enterprise value, because if you're trying to write off all these lifestyle things through the partnership or through the operating entity, it's very tough for me as an investor who wants to buy your company to look through that P&L and identify what's actually, what can I add back to the profit. If it's simply these management fees, I can ask you, like, hey, do you have this set up for tax strategy? I can add back those payments to the profit of the company and easily underwrite the deal from that perspective. So it's much easier from an enterprise value standpoint.
Yeah, I think we did that change in 2023 once we got a financial advisor on board.
Yep.
And that was it made a lot of sense to us.
Yep.
We're also doing some really interesting stuff with life insurance. There's some weird stuff going on.
Sure.
I don't fully understand all of it, but that's okay.
Yeah, I'm an advocate for life insurance, especially if you have partnerships, buy-sell agreements to make sure, like, God forbid, you pass away, the life insurance funds the business so that Scott can easily buy out your shares and doesn't have to go into business with your next of kin.
Yeah, we have a Keyman life insurance, which pays out if either of us dies. That's owned by the company. But also our personal life insurance policies now get paid out to the company, which is a weird tax loophole that I don't fully understand. But once that payout goes, it has to be used to buy shares in the company and then pay out your family member, your next of kin.
Could definitely, because life insurance proceeds, if we do it right, are generally tax-free. We go one step further sometimes. If the business wants to continue to capitalize effectively, you can use the life insurance as a corporate-owned asset and do it in such a way where, let's say I use a policy that gets me a high enough death benefit, but maybe I do what's called overfund it to get about 90 cents of every dollar I put into it available in the first year. And over time, that liquidity builds. When I contribute to it on the corporate side, it's technically considered a non-deductible business expense. And so with that, I can't get a tax deduction for it because the back end is tax-free, but it increases my cost basis into the company. Yeah. So if I ever want to sell, it actually mitigates the capital gains from the exit on the back end. So it's a cool way to capitalize your business effectively, retain the liquidity, manage the buy-sell agreement, get the life insurance in place, but also, mitigate the exit and still keep the liquidity on the back end, depending on how you negotiate it.
It's such a fun entire language of like tax and finance.
Fun stuff.
It is fun stuff. I'm actually doing something pretty fun right now that I'll share. Bought a Cybertruck yesterday. It comes in on Wednesday. So very excited about that. But one of the reasons I decided on that car is it's over 6,000 pounds and you get a $7,500 tax credit on the back end.
Yep.
So I probably could have waited till 2025 and gotten the $60,000 version or $80,000 version. But I'm trying to get tax savings every single year, because if I don't have that, then I have to pay it all to Uncle Sam.
Sure.
So that's a specific, I don't want to say loophole, but tax strategy that individuals can use to save, or S Corps or LLCs. So over 6,000 pounds, I get to bonus depreciate 80-90% of this thing in the first year, because 80-90% business use, which is gonna kind of like getting a 35% discount on the car, because that's kind of what I'm going to be saving on the back end, plus the $7,500 tax credit. So talk to me about vehicles and whatever tax law that is. How does that all work?
So this was definitely more exciting in 2022, and we're waiting for the Congress, who I'm not going to hold my breath, for them to pass a bill to bring it back to 100% bonus depreciation.
What is it right now?
It's at 60% in 2024 right now. Yeah, it's very icky. Yeah. It makes me very upset. I've just been waiting for it to come back. It was 80% last year on any assets put in service last year, and then 100% from 2016 to 2022. And with that, when you buy a car that's 6,000 pounds, it's going to hit two specific things. Your CPA is going to use a combination of Section 179 and max out what we can on the vehicle, and then also use bonus depreciation for whatever's left. So you're likely not going to get 100% of that vehicle deducted this year, given that bonus depreciation is there. But if you actually needed another vehicle, this is where we want to buy it in the most tax advantageous way, like you just did. So I'm a huge believer in, like I said, not to spend $1 to save 30 cents. If I don't need a car, the math doesn't work out long-term, because of the fact that I'm still stuck with the payments every month. Right. So 3 years from now, I'm like, oh, great, I saved taxes 2 years ago, but I'm still stuck with this payment.
Yeah.
And if you try and sell it, you're going to recapture some of that depreciation if you try and sell it before 5 years.
And Tesla will fuck you with like a $50,000 fee for reselling your Cybertruck.
There you go. So with that, it's really only contingent upon you actually needing the truck. So let's say that you truly needed it.
Yeah.
Now, looking at the Cybertruck, I know I need it. No matter if I actually need it for business, I need it, right? So
I need it.
Yeah, psychologically, you needed it. So we did it in such a way to maximize the tax impact there. That's where I would identify expenses. Like, for example, construction companies. Work with a ton of construction companies. A lot of construction companies end up just at the end of the year buying a ton of equipment just to save money in taxes, and they zero out the net income of the business every year just from construction, from equipment purchases. But what happens when the equipment like breaks down? I got to pay for maintenance. I'm still financing the equipment over X amount of years. So we always are big advocates for making strategic key investments into the business. And if we have a long enough time frame, you can kind of choose what you pay in taxes in that world. So that's why I'm, right now, currently, before this podcast, I had 5 check-in calls with my clients. June and July are just tax planning calls, because we do a ton of things else outside of tax planning. But June and July, I want to get really solid profit and loss data so we can start projecting out what we're going to look like. So now we have 5 to 6 months to really start making these plays, because some of them take some time. And if we're doing anything past December 31, we're likely looking at a history book. And so if you don't want to commit fraud, everything has to be done before December 31. So proactivity is my number one recommendation when it comes to taxes. That's the best strategy. Be proactive. Get the right team of professionals on board. Then start to identify pieces that I can use as tax credits, because tax credits are really effective because they're dollar for dollar off of your tax bill. I spend $1, I save $1. Depreciation opportunities, because now I can use leverage. For example, you pay for the Cybertruck, the bank's going to pay for most of that, in most likely. I don't know how you structured the deal, but maybe you're paying $1,000 or $2,000 a month for the Cybertruck. The bank's, financing whatever the rest of it costs, but you still get the deduction for most of the value of what it actually costs.
Yes.
So, for example, I bought an Escalade in 2022. The bonus depreciation was still 100%. I bought it in December. And the cool thing about buying it later in the year in that aspect is you have so much less time to actually substantiate the business use. So if I buy it midway through December, I only have to justify the last 15 days or so of the year for business use.
Interesting.
So now I can be more aggressive on that side because I have a short enough time frame.
Say it's 95%.
Exactly. And so I actually was able to write off pretty much 100% of that car.
Awesome.
I only paid $1,000 plus my small down payment. Not a huge believer. I don't want to say huge believer, but not a big advocate for down payments. I can make more money than the interest rate provides with my liquidity.
Yeah.
So I just negotiated it, rolled it in, very small down payment. Let's say I dropped $2,000 for the Escalade in the first month. I still got an $80,000 write-off. So just identifying opportunities for leverage, then getting creative around the deduction side of things. What am I not taking deductions for the money I'm already spending on? Comb through your personal P&L as well. Look through your bank statements. Identify opportunities to use something like an accountable plan with your S-Corp, reimbursing yourself for personal expenses you took. Unreimbursed partnership expenses. You guys are partners. Things that you took personally that should have been attributed to the partnership, you can have the partnership potentially reimburse you for those things. And then deferments. Deferments are the last one because it's not true tax savings. We're just kicking the can down the road. Could be super effective, but we use deferments as a last alternative. For example, 401ks, retirement plans. Great things, but a CPA is generally going to tell you, hey, put this money into a retirement plan.
Yeah, CPAs,
as a business
financial
owner,
advisors, they all do.
because everyone makes money and it's the easiest strategy, right?
Yeah.
But you don't retain the liquidity, which as a business owner, I don't want to wait till I'm age 60 to retire or like have access to my money. I need my money now. So retirement plan is going to be the last resort, in my opinion. I use a really unique strategy, which is a pass-off income strategy, I call it, which is really cool for people that use payment processors or people that collect money but via physical checks, which we work with a ton of coaching companies,
Yeah.
and we work with a ton of construction companies. They get paid in physical checks sometimes. If I have a really optimized balance sheet, let's say like my liquidity in my business is 3 to 6 months plus of expenses. So I have enough runway to where if I don't make money this month, I'm still able to float my business expenses. Mm-hmm. Let's say, for example, we have about $300,000 of revenue that's coming in December, and my operating account has $500,000. I'm going to call Stripe, whoever my payment processor is, and I'm going to say, hey, I want you to collect all of my client payments, but I want you to hold the money up until January. I don't want you to pay me until January. I now just bought myself an entire 12 months to realize that revenue and create real tax strategy, maybe buy real estate and do cost segregation
Right, wow.
to wipe that out. I parlay that with a spend down program on the expenses that are going to come up in January anyway.
Yeah.
I see if my vendors are open to me prepaying, et cetera. So now I'm under collecting and overspending on the things that I was already going to spend money on anyway, which results in a significantly lower tax liability today. I have my liquidity next month. I start to make real tax plays that are going to wipe that out. So that's where
so
deferments can be
interesting.
super powerful.
Never heard of that. And they're probably happy to do it. You call up Stripe, keep my money for an extra month.
Yeah, they'll go invest that and make significantly more than just paying you out. So
Amazing. And
So
then
I recommend, as long as you're going to do it with vendors that are truly going to pay you out. So if there's any opportunity for them to not hold your money, I'd rather pay taxes than not have my money. So definitely be cautious about that and talk to your professionals about it.
do you tell the vendors not to? Oh, by vendor you mean Stripe, not the client who's actually paying. You're not telling your client, let's wait until January for that invoice.
Yep. So exactly. So you're still accepting, like you're still operating business as usual. Your clients
Yeah.
have no idea you're running the strategy because they're still paying you, but you're calling Stripe and the merchant is holding that money up. Then I'm calling my vendors in terms of like my outsourced professionals, anyone that I'm doing business in that are aligning with my expenses, and I'm seeing if they're open to me prepaying them instead of just like auto paying in January.
Gotcha. So try and dump as much money as you can before the end of December.
Exactly. On things that you're already going to be spending money on.
Right.
And it's very contingent upon you having the liquidity in the business, but this is all contingent upon all of that being optimized.
That was one of the strategies our CPA suggested. It's like, you're running Facebook ads, just like spend $100K on Facebook ads and you'll have those credits.
The challenge is with ads specifically is that like they have to parlay with the proper fulfillment as well. Like, can my sales team handle double X ad spend this year, this current month, et cetera? So ads, you could do it for sure, but we want to make sure that it aligns with that strategy. If they're giving you credits for it to then run it, possibly.
Right,
Definitely.
just sits there in your Facebook ads wallet
yeah.
and you can run that for the entire year. It's essentially kicking the can down the road every time you're doing something like this. Like, you might not be responsible for that tax burden in 2024, but now in 2025, you got to figure out what to do with all that extra money.
Exactly.
So what are some of those big moves? If it's not buying a real estate building, if it's not buying a fleet of cyber trucks, like what are some big moves that you can make to save?
There's things like commercial solar projects that are pretty hot right now. There's companies that basically allow you to purchase part of an LLC that has a commercial solar project attached to it. You use leverage to get the LLC. then you get a tax credit and the depreciation for the actual solar equipment as well.
Nice.
It's not a crazy investment in terms of making a ton of money, but you have the highest opportunity to preserve your capital. So if I'm able to do that and still get my money out in the next 10 years, let's say I invested $1 million in 10 years, they give me $1 million check, and I save taxes along the whole way, then it's definitely worth it.
So playing on the government benefits, especially
exactly.
around, okay.
Now, inside of that strategy, they're going to help you create what's called material participation. The material participation is what allows you to take it off your active income, or else it's against passive. Same thing with like the real estate professional strategy.
Yeah.
And so with that, commercial solar projects are great. If you don't want to just buy equipment, you can potentially explore like a Section 179 fund where you purchase equipment with a group of people, and that depreciation passes on to you. Oil and gas partnerships, kind of the same way that commercial solar projects, but less of an opportunity to make your money back, because a lot of times they're going into the ability to strike oil. Sometimes you make a crap ton, other times you just get the deduction and you lose your money. So really just taking advantage of other leveraged opportunities. For example, a lot of people just buy businesses for the tax value of it, right? So for example, if I have a massive tax liability and I can negotiate the sale of a business and do it in such a way to where it's potentially an asset purchase where I'm then reinflating through opportunities and negotiations the tax value of that company, I'm able to take a ton of depreciation off that on my ordinary income this year.
Yeah, that's another one that we considered, buying businesses.
Yeah. So it really all has to align with what you're actually looking to do.
Right.
Giving specific advice is very tough because it's no longer a generality,
100%.
So,
all right, let's talk about the ultra wealthy. What are some of like the centimillionaires doing to preserve their wealth? There's trusts, there's all kinds of different tactics that they're using at different levels. You talk about some of those strategies?
Sure. So, one thing to make sure is when people are talking about trust for the purposes of asset protection, oil and water when it comes to taxes. Do not set up a trust that someone says you can save money on taxes on. That's likely fraud. Now, there are some trusts that can allow you to potentially defer capital gains, like a charitable remainder unit trust, a deferred sales trust, Delaware statutory trust. Those types of things give you opportunities to potentially save a ton of money in taxes or defer a bunch of money in taxes. Those are things like when I'm selling a business, if I could find ways to mitigate. Qualified opportunity zones are another huge piece. If I sell a business, I can basically defer the capital gains into an investment in a qualified opportunity zone. Then ultra wealthy people are looking to get money out of the estate because there's no specific tax strategy to wipe out ordinary income that the ultra wealthy are doing that we don't have access to as well.
Right.
They've just done it for a long enough time that they've been able to grow ultra wealthy because they paid less in taxes, and they've obviously made massive plays in real estate, private equity, crypto, whatever that looks like in their world. Now these ultra wealthy are focused on potentially getting dollars out of their estate to pass it down to the next generation. And so using forms of different types of irrevocable trust to gift those shares away to get them out of their estate, and ultimately lowering the estate tax, and then using things like life insurance mechanisms to avoid a lot of the state tax as well.
When you say estate, you define that for the ultra wealthy. Is that just a big property? Like what is an estate?
So your estate is your accumulative net worth. So like everything that you've amassed over the years,
businesses, my crypto holdings, that's all part of my estate.
Yep. So everything inside of your estate, your cash, your holdings, your percentage of equity in your stocks, et cetera, if done in such a way, you can minimize what that estate looks like for the next, generation, so that they don't have to pay a massive estate tax, or you have mechanisms to fund the estate tax to pay it off. Because if you're not proactive, sometimes you get hit with a massive estate tax bill when you die. Your heirs now have to sell off these assets at a discount through a fire sale just to pay the taxes, and now everyone's broke, and now generational wealth is disconnected. So this is why things like life insurance exist. Things like estate planning, wills, trusts, power of attorneys, all those types of things are super beneficial if you get it done proactively.
Is there a different type of professional that you should be working with at that level, the ultra wealthy? Like who should be in their corner?
I think having what I like to call a fractional family office, or at that point when you're ultra high net worth, a family office that you have attached to your entire thing, where it's a team of lawyers, CPAs, financial advisors, just dedicated to all your stuff. So I wouldn't say anyone specific, but specific to the people that have experience working with ultra high net worth individuals, which, we have a ton of those people in our network. And so with that, we are at the point where our business serves the rising business owner, right prior to they become ultra wealthy, where they need a fractional family office. They're not at the point where their own in-house family office makes sense, where they're not 40, 50 million plus of net worth. We have some of those types of clients, but we're working with clients that are doing, 10 plus, 8 plus figures, 10 plus million in revenue, where they have the opportunity to create that amount of wealth, but they still need a team of advisors that are in alignment for their benefit, not the advisor's benefit. Because I've seen it way too often to where my financial advisor, my CPA, my banker, none of them are communicating with each other.
Right.
And everyone's giving you varying opinions based on how they get compensated and how little of time they can put in. And so we've solved that problem by being that centralized hub that builds out that team and then make sure everyone's doing it in an unbiased fashion to benefit you the most, to ultimately mitigate the stupid tax that you pay by hiring bad professionals.
It makes so much sense having all the professionals under one roof that are actively on the same page with the strategy and executing on that strategy.
And most importantly, it allows you to streamline your thoughts to stay as most effective inside of your business on what generates you the most money, knowing that you have a team behind the scenes that's running all the plays. And then you only have to come to the table when it's at the finish line just to sign off on it. Because I don't know about you, I'm the type of guy that I just want to have trusted professionals in my corner. I don't need to know how the watch is made. I just need to know what time it is. And so you tell me what time it is. Hey, we're going to save this much in taxes. Here's the plays that we're going to run. You don't got to tell me how we'd get it done. As long as it's under the scope of integrity and I trust you, I know that team's going to get it done. Now I can focus on whatever makes me the most money or gives me the most happiness in my business, the most fulfillment, the most impact, etc. And the biggest part of that, which people don't see an immediate ROI from, is, let's say, for example, I'm writing a book, and that's like the highest revenue generating activity or the highest fulfillment activity.
Sure.
If I'm writing a book knowing that I have bills to pay or that I have tax strategy that I need to run, etc., it's not allowing me to be the most effective when it comes to operating my business or writing the book or being creative, etc. I need streamlined thoughts and the ability to do deep work without thinking about things in the back of my head that are ultimately deterring me from being my most creative self, which is why it's so important to have a big team like that.
That's been my biggest selling point for telling people to go get a financial advisor. I spent like all of 2020 and 2021 just like balls deep in my Robinhood app, just like swiping away, losing myself a ton of money, and then just watching it every day, spending hours and spending my sanity, just like losing money and just following everything as closely as possible.
Sure.
My financial advisor came in, got me out of a deep hole, and now I haven't looked at my money for probably a year and a half, and it's one of the most relieving things I've ever done. It allows me to focus on business. So I can only imagine not only having a financial advisor in your corner, but everybody else.
It's completely different when you're an entrepreneur, because very well said. When you're an entrepreneur, and we only work with entrepreneurs, the financial advisor relationship needs to be significantly different than if you were just a W-2 employee, which there's nothing wrong with that. But if you were looking to, retire at 65 or et cetera, like it's a whole different game plan than understanding the nature of a business owner, which is why financial advisors and business owners typically clash. Because a financial advisor is trying to compete against your best rate of return, which is your business.
Yes.
If I could go make 30, 40, 50% in my business, why do I need to take all the risk outside of my business on Bitcoin, the stock market, et cetera? Nothing wrong with those. And you should have exposure over time to them for long-term wealth. But if I need to pay payroll, my money needs to be liquid. I could still be performing in cash alternatives, but I need access to my money because I'm going to get super wealthy by making plays inside of my business, at least my philosophy. If I'm prepared well enough and I have the liquidity, specifically in this time, 2024, where credit is tight right now and money is not cheap, if I have liquidity...
Real estate sucks.
Exactly. I'm within reason.
Right.
So with that, if I have the liquidity to go buy market share at a discount, my competitors are listening to their financial advisor, investing all their money in the 401k or not making profit or just not having a balance sheet in alignment with their vision. My competitors are going to go out of business over time. Unfortunately, but fortunately for me as a capitalist, that's going to happen. I'm able to get better employees for it at a discount and also buy their book of business at pennies on the dollar. And so with that, I'm waiting for those plays and sacrificing a little bit of short-term rate of return from the market to know that I have the liquidity to go buy market share and talent at a significant discount when the market turns.
Yeah. I think that relationship's important. I'm blessed to have that with my financial advisor. Let me ask you, and this came up with me and my business partner last year, is do we need a tax attorney? Let me ask you, what is the role of a tax attorney and at what point do you need one?
It's a great question. To understand tax compliance tax attorneys are definitely going to be significantly more efficient in that world. I wouldn't say you probably need a tax attorney right now, and I don't know your situation. The threefold is, the strategist, the CPA, and the bookkeeper. Yeah. Now, a tax attorney, when we're going towards more legal type of things, audits, etc., it's super beneficial to be very proactive with that relationship, because you don't want to get audited, then automatically need a tax attorney, or be past due on your tax bills and then try and get a tax attorney. If I have a great relationship with someone, you probably don't need them on retainer right now, but having a really good relationship with someone who knows your things, they're going to go to war for you when it comes to the legal side of everything, because ultimately a CPA is not a lawyer. I'm not a lawyer. Your bookkeeper's not a lawyer. So we need somebody to be in compliance with the IRS, and they become your liaison so that they can speak on your behalf. That's at least what I've seen a tax attorney be.
Do you need one if you get audited, or do you only need one if you go to court?
I would definitely consult with a tax attorney if you're audited.
Yeah.
Your CPA can likely continue to translate and talk to the IRS, but it depends on the level of audit and depends on like what you're being audited for. Right. If there's a misrepresentation on a couple things and they're just asking for some clarity, totally different than if you're truly committing tax fraud. Yeah, exactly. So I hate the answer if it depends, but it does depend. Yeah, for sure.
No, that's fair. All right, briefly, let's talk about some tax saving strategies for non-business owners, maybe 1099s, doctors, lawyers. Are they just screwed, or are there any options in their pocket?
Start a business. A big strategy for 1099s can definitely, save. They just operate on Schedule C. So the biggest misconception with 1099s is that I need an LLC to start taking advantage of tax savings.
They don't.
Totally different. LLC is just a legal entity. What it does is allows you to potentially create that LLC and then file it as an S corp, because now we can take advantage of the strategies that we were talking about prior. But somebody that's making 1099 income is subject to the same exact strategies that you're taking advantage of on your non-W-2 income from your business.
They don't need an LLC. They don't need a business bank account. They can just deduct things.
I would recommend that they do, just because it's significantly easier to track.
Right.
Because if I set up the LLC, now I have a business bank account. I also have some legal protection as well. We could definitely talk about that, because it's not crazy legal protection. It's a thin layer of a corporate veil. But with that, that makes it easier to categorize my personal expenses versus my business expenses, things that are related. W-2, highly compensated W-2 professionals. Obviously, there's deferment strategies like your 401k, et cetera, which you probably should at that point be deferring some of the income into those. Then you have strategies like real estate, like things, pretty much anything that you can find a way to create material participation around that can wipe against active income, because W-2 is active income. So the most popular strategy right now is if I'm a highly compensated doctor or highly compensated lawyer, et cetera, that works for a person.
Yes.
Excuse me. Like I work for a firm, not owning my own firm.
W-2, right.
W-2 salary. Buying real estate and having your spouse become the real estate professional in that strategy is definitely one of the most effective ways right now.
Gotcha. So you take say it's 500 grand W-2 income, put it into an LLC that you start with your wife, and then buy real estate into that LLC. And then can you depreciate your 500K? I mean, that's W-2 income, or do you taxed on that?
So with that, you don't even have to start an LLC. You need to justify the hours inside of real estate. So your wife would technically need to, or your spouse would need to identify with 750 plus hours in the world of real estate.
Is that strict? Classifying as a real estate professional? Because I've been told it's just a checkbox on a form.
You can say I'm a real estate professional, and if you don't get audited, great, you're a real estate professional.
Right.
I operate in the assumption where you might get audited, so let's do our absolute best to justify substantiation. Yeah. There's really cool software now that allows it to make it significantly easier to track. There's a thing called REPS Tracker, Real Estate Professional Status Tracker, and it's a software that literally allows you to track the hours. And so with that, let's operate under the assumption that your spouse does qualify for real estate professional. I can now invest in my own, family, single family, multifamily, whatever asset class you want in real estate, and justify that she's helping manage those properties. Now I'm able to do potential cost segregation on that. You put $500,000 in, you're likely not going to get a $500,000 deduction. But the cool thing about real estate is I only, let's say, have to invest $100,000 for a $500,000 to $1 million asset, dependent upon how I structure the deal. Cool thing about today's environment, and I guess always it's been around, but creative financing is super popular right now. I'm doing deals right now on the commercial and residential side, where we're less than 10% down payment out of pocket, 5% less interest rates on motivated sellers, less I have out of my pocket, I still own the asset for the value that I purchased it at, whether it's through the bank's money or through seller financing, et cetera. Right. So in a traditional sense, let's say I put $100,000 down, I get a $500,000 asset. Rule of thumb, maybe like 25 to 35% of the value of that you can do in a cost seg and get the value from. You're probably investing $100,000 to get about $100,000 to $200,000 deduction in that world. So now it's pretty solid.
Yeah, now you're not paying taxes.
You're getting a massive discount on your investment into that property, into a really tax advantageous asset class that's really good for eventual cash flow and wealth building. And so that's the way that I start to see it, is that it's not, one-to-one tax savings, but would you rather just pay the money, or, you have to invest somewhere? So that's the way I see it.
So it's stupid not to buy real estate if you're a W-2 employee making hundreds of thousands of dollars in income.
If you have the capitalization for it, if you save your money wisely, that definitely might be something you want to explore. What's stupid is doing nothing.
Right.
And complaining about it.
Instead of that,
if you do nothing,
your down payment, that 100 grams going to Uncle Sam.
If you do nothing and you're happy about it, great, good, kudos to you. But if you do nothing and you're complaining about it, then I would say it's definitely stupid.
Fair.
And you're ignorant, and you should probably invest in a personal development book as well.
All right, Antonio, what kind of clients do you serve? I know you do fractional family office. Who's a good fit for something like that?
So our clients fall under what I like to call the stage 2 growth-oriented entrepreneur. Someone who is beyond 7 figures in revenue. I would say, $2+ million, where there's enough meat on the bone for us to be significantly effective. Primarily, most of the people we work with are service-based. I can just advise better under the world of services because I own a service-based company. Yep. We sometimes work with consumer packaged goods, direct-to-consumer type of brands, e-com, et cetera. We're definitely effective in that space, but a lot of service-based entrepreneurs hire us. And we are effective in the world of asset protection, making sure that your strategy is bulletproof so that I only have to get rich once and no one catastrophic event could take me down, making sure that I have the proper insurances, my operating agreements are in place. I own my assets in such a way where no one catastrophic event could take me down. Taxes. I'm not a CPA. I'm never going to file your taxes. I don't want to do that. With that, we are filling in the gaps where most CPAs are dropping the ball, which is on the proactivity side. If you and I are connecting over your business once a month, I know your scenario. I could start suggesting things that are significantly more advantageous as opposed to your CPA that maybe tells you about your quarterly tax payments and talks to you in April.
Yeah.
So with that, on the tax side, we have tax planning, which is let's start taking advantage of everything that we're spending money on today. And then we have tax strategy, which is let's make sure that everything that we own has an exit strategy attached to it so we understand the tax impact behind it, and also making sure that we're not just deferring money to then eventually pay a massive tax bomb down the road. Then we focus on creating an ecosystem of unbiased solutions on the wealth management side in the world of cash flow, wealth management, all those types of things, to make sure that your balance sheet is ultimately in alignment with where you want to go. If you're telling me that you want to sell your business in 5 years and I look at your balance sheet and it's completely in, everything's in high risk crypto or the stock market or 401ks, et cetera, it's probably not in alignment with being prepped to grow or exit, et cetera, down the road. So we're making sure that we're optimizing profitability while also making sure that where we're putting our money is in alignment with where we want to go, which comes down to making sure we know where we want to go. So a lot of mindset work, a lot of collaboration, especially if you have a partnership, making sure that you guys know exactly what the partnership needs and what your goals actually are. And then on the back end, consulting through exit, making sure that succession, if you had kids and you want to hand it down to them, it's done tax efficiently, and also estate planning, et cetera. That's kind of where we optimize. The way that I think about it is, let's say you have a general contractor that's going to ultimately make sure that this project gets seen through to implementation, but they might not have all of the infrastructure to do it all by themselves. They have subcontractors. We're making sure that we're the general contractor of everything. We have a ton of in-house solutions, but then we're also going to make sure that we hire the right team members on your team to get those jobs done. So I'm making sure that you can sit in the right seat as an entrepreneur and focus on making money and doing the things that you want to do, traveling, et cetera. And we're making sure that you keep it and, maximizing all the tax advantages, et cetera.
All right, beautiful. I mean, everybody needs someone in their corner that they can trust with their finance and their strategy. And as you start making money, it's good to have that before you're trying to figure out what to do.
Yes, sir.
Because then it becomes a lot more complicated. Antonio, I appreciate you sitting with me today. Where can people get in touch with you if they're interested in working with you or hearing what you have to say?
Yeah, I'm pretty active on Instagram. I answer my own DMs. I don't have any appointment setters. So Antonio Vaglica Jr. is my Instagram handle.
I'll link it down below. That sounds like a lot of words.
Perfect. Yeah, yeah. So Antonio Vaglica Jr. You'll link it there. Other than that, yeah, that's pretty much the main channel to get through to me. Starting on YouTube this year, which you've inspired me.
Hit me up,
how
brother.
good it is. Other than that, not too active on Twitter. Yeah, I would say Instagram probably the easiest way.
Yeah, best way to get in touch with me too. Instagram DMs is the shit. Well, Antonio, thank you, brother. It's a lot of fun.
Appreciate you having me.
Back at you.